Yeah, I'm losing my edge.
We're going to size futures with trade stats here today, Pete. This is something that I started talking about a little bit with Michael last week, and I wanted to get your experience on this topic because I think you're one of these people, Pete, who's been doing it for so long that you don't even think about it, but it's baked into your process, whereby it's like, say on a day like today, where you've got equities higher, all-time highs in equities, you've got metals, big move higher as well. And you say to yourself, I'm not just going to flat out sell 2 or 3 contracts in both of those markets. You're going to size those things differently according to your confidence in the trade and where you want to be, and of course your other positions. But for today's conversation, we're just going to assume that you're flat, you've got no positions on. And so I want to talk about how you size futures, Pete. And I think that the trade statistics that I'm going to weave in here are kind of baked into your subconscious already. I mean, do you want to give a little synopsis of, from the most broad viewpoint, if there are 3 or 4 asset classes, Pete, that are higher by a lot, and you're looking at some short opportunities, some going against this big move in all those asset classes, they differ. You're going to make varying decisions on the size, right?
Absolutely. And you know what, and you mentioned this, you've got an up move in every commodity. Gold and silver off their lows, corn contract highs, equities contract highs, Aussie up almost 100 points. The disconnect and crude above $58. We're briefly below it, but I mean, I don't consider a 20-cent break off of a $7 up move that far off of it. So it would be very easy to say, let's play all the extremes. So I'm sure crude, corn, Aussie, and the equity indexes. Now, I look at that, obviously 4 separate distinct markets. That is way too much of the same position in my mind. So I look at a little bit of the outlier. Even bonds are up today. Now, my biggest position is in bonds right now, and I'm short bonds. I started below 67 and then above 67.10. The long yield part is not necessarily what we traditionally see with an up equity market. So that's the disconnect for me. I look at that as a little bit of the hedge against some of these other positions. So sizing, so overweight in bonds, underweight because I do have a little bit of crude. I just put on a little bit of corn. I have short equity deltas, and I added some Aussie here.
Sure.
So what do I have against it? Not a lot right now. By the end of the day, I will find one more thing to put against it too. And in my mind, putting something against it lowers the size a little bit.
Sure.
But each one of those, because I have 4 positions that I believe are all the same tilt, so to speak, each one of them is smaller than if it was just an occurrence. If it was you and I talking on a Friday, I like this extreme. It is smaller than that.
And that's a good example, and we'll get into kind of the nitty gritty of how Pete gets to those decision makings. But even within that example, just to start here, a good differentiator is the fact that you would probably have a larger short Australian dollar position than you would on a day like today in crude, equities, and these other markets. Because and why Pete does that, a little bit of the gears turning in his brain, is that is a distinct market that he perceives a whole different kind of edge in relative to crude oil, equities, and a few of those other asset classes. They move higher and lower in tandem. And that's a great first piece there, Pete, with diversification. That's actually where we'll conclude. But let me do a little bit of contextualizing here using the small yield product that moved through its projected high and has been kind of on a grind higher, which could provide a slight edge to shorts. And now edge is going to be a key word. It was a key word in our last conversation on sizing. And I think it's something that Pete, it's one of those words that you don't use a lot, but it is baked into all, like you don't take a long or short position without some perceived edge in your mind. And I think that the amount of that edge, Pete, is what dictates the sizing in your futures, because I want to bring in this small US dollar, which is a little bit of the reverse story of that Australian dollar that Pete was talking about, because this market moved higher as well. And it's moved off of those highs. It moved lower at the end of the week. Now, Pete, the decision between, selling 1 or 2 contracts in one of these products or 3 or 4 or 5 in the other is going to come down to your feeling as an experienced trader as to the edge in that product. And here, for instance, you talked about the fact that interest rates, big move higher last week, but with the context that we have as experienced traders, big move higher into what has been a normal range for interest rates. Whereas last week's move higher in dollars kind of came out of nowhere. We thought it was more of a move, like a random move that it's like, I don't know why this dollar is rallying. And so maybe a little bit more edge. Maybe you got about a 65% confidence in that short dollar trade as opposed to 55% confidence in that short yield trade. And that's going to dictate size for you, right?
Yeah, absolutely. And you know what? I like the fact that you're wrapping these metrics around it, start to define, as you said, moving that. We don't like to trade with just the idea that it's too high or too low. We like to find that starts the bias. That doesn't really take us through the bulk of decision making. So the idea is we have a bias. How do we move the 50-50 knee on a product with no premium that has a binary outcome? So you're absolutely right. This is the way we start to look at it. And this is the way we start to look at the move relative. Also, part of it too is the move relative to what we have the expected move for the week being. So that's part of what you're incorporating both your bias and some statistics. And that's a great place to start.
Yeah, absolutely. Because you nailed it, Pete. It is a matter of, first of all, we won't do any trades that we think we have a 50-50 or worse chance of.
I'd rather go bet Pete Santori. Right.
Well, exactly. If there is no edge in the market, you might as well just, betting on, like yesterday with the Super Bowl, bet on the coin flip of the game, like heads versus tails. You haven't done any research to be like, oh, well, it's not a weighted coin. There's no bias in that trade. So why even spend time committing it? All these trades have some edge, but they have a differing edge, Pete. And that, like I said, dictates the trade size. And maybe you can illuminate that process a little bit here, because thankfully with small exchange futures, these different asset classes down the line, we're looking at currencies and yields here, but we also have equities, we have metals, we're adding oil soon, we're adding crypto soon. All of those different things moving, presenting opportunity on a daily basis. They all allow a great amount of flexibility, whereby one contract in each of those asset classes is pretty similar. And so it's easy to kind of say, hey, I think that I have a 60 or 70% chance of this market moving in my direction. I'm going to commit 2 or 3 units there, as opposed to, this one, it looks like a decent opportunity, but I'm not super confident in it. I'm just going to put a little taste on there, 1 unit. And it's as simple as that with these small exchange futures. I mean, maybe you can give an example to maybe this last week of trading, or even today, if you're looking at something like equities and metals higher and you're more confident in one or the other. It's as simple as changing the size up with units of futures.
Yeah, absolutely. And that's, that flexibility is an incredibly powerful piece. We talk about not only sizing for a number of reasons, sizing the scale up and down, the amount of exposure as we're doing in this particular, what you're walking us through this great piece of content. We also like to use it to optimize our trade location, our average price. If we're using big futures, you don't have that luxury. You got one dart to throw. I like the ability to throw a couple depending on, as you stipulated, where statistically I have a little bit more of an edge. It's a tremendous amount of flexibility to add into your trader toolbox, as we like to say. So, that's an important piece. I think the idea here of, and you could have what I like too is, Frankie, because you see the short 2 and the short 1 here, if you're so inclined and you have a different bias on rates, that they've run their course and this disconnect is a little bit severe, you can flip that 2 and 1 over. There's where you can exert your bias and actually tweak that bias, which is really important. So for me, I think that, I look at the ability to scale with these products, and that's incredibly powerful. Also, the ability to choose on this extreme here, the ability to adjust my size. And I think for me, the dollar trade here, we know that we've been looking at that new range of the dollar, 142.5 to 146. So we're at the upper end of that. Do I want to commit on a product that moves a little bit less than our interest rate product and isn't quite at the same extreme, do I want to commit a little bit more units to it? Absolutely. And manage them in a staggered fashion. That's really important. So that for me is the important aspect here of sizing, that I don't have to just, I want to have 5 independent occurrences. I don't want to have to just pick one of each, because that in and of itself, as you pointed out here, does not let you tailor your ideas and statistically your opportunity to what the market's giving you.
Yeah, absolutely, Pete. And those are a bunch of great points there. The flexibility of the size of these futures allowing you to go from, on Friday afternoon, maybe you put 2 of these short dollar trades on, 1 short yield trade, and you flip-flop those things as maybe dollars move in your direction. You take one of those off and the yield continues higher, you add one of those. Great flexibility there. And the last thing that I wanted to hit here is the fact that you don't go away from those 1 or 2 unit trades, though, relative to your other trades there, Pete, because diversification is absolutely key. And it's funny, this is kind of where you started out with to kick the segment off, where it's like crude oil is up, equities are up, some of these currencies against the dollar are up, metals are higher as well. And it's not a matter of I'm most confident in equities going lower, so I'm going to put all of my money to that trade. Right. It's a matter of if I'm most confident in that, maybe I'll do 2 or 3 units there and 1 across the board. But you've got to put all these strategies that you perceive edge in to work, Pete, because this, we joke about this all the time. It's usually the one you weren't expecting that moves in your favor, and you don't want to miss out on that because you placed one big bet. This is why you bet, that the game result and the over under and a couple other things, as opposed to committing all of your capital to one big bet, right?
Absolutely. And that is the disproportionate nature of us all. We're all defined by, except for a precious few of us, by the amount of capital we have. And so how do we meet the opportunity in markets like today, where you're getting statistical edge in more than one product, varying degrees of it? I want the flexibility to increase. We've proven that increasing your number of occurrences and staying smaller with those leads to, in the long run, a more successful outcome. So this is where it's so important to be able to, it doesn't mean every single day you have to have 4 different asset classes on. We've been empowered by the choice that there's good things to find depending on the day, but that's the flexibility that we want to have. So I think that piece that you keep going back to is so important. The sizing of the product, the number of occurrences, and then looking for that statistical edge. You go back to strategy and you start with bias and then walk through those 3, you're going to end up tailoring down what is an interesting trade. And then you're going to look at proportionally sizing that trade, which is, that strategy part that you make mechanical is so important, because then your mechanics become clearer. And your management is just a task. It's not I'm not vested that I've taken too much on. So great walkthrough in terms of how do we identify opportunity and how do we make the most out of those statistical opportunities.